I want you to think about two people for a second. They're both 58 years old. They both have about 500,000 US dollars saved up in the bank, and they're sitting in the exact same investments. And over the next 20 years, their portfolios generate the exact same average annual return. However, one of them will run out of money at 75, while the other one will still enjoy its retirement fully with over $400,000 left in the bank. And the only difference between them, the only one, is the order in which their returns have arrived. So that's what this video is going to be about. And I think it's one of the most important things that anyone with real money in the market right now either A, underestimate, or even B, fully ignore. So if you don't know me, I'm Alexandre Allemand, and I founded Kronos Trading in 2021, where we run a fully automated trading system that's returned roughly 53% a year across 300 partners and about $20 million under management. And the reason I'm bringing this up is that the market right now is setting up conditions where this specific risk is about as elevated as I've ever seen it. So you'll definitely want to stick around because toward the end of this video, I'm going to show you why the current environment makes this so much more dangerous than it actually sounds and what actually can protect against it. So to properly frame this, I need to make the math crystal clear first. Both David and Sarah have $500,000 saved. Both start withdrawing $30,000 a year to cover for their living expenses. And over the full 20 years, they both get the exact same average annual returns, the same percentages, the same numbers, only in a different order. So David gets the bad years first. His portfolio drops 30% in year one. It's now worth $350,000. And here's where it starts to break down. He still needs his $30,000 a year to live on. So he has to sell shares at his at those lower prices. His portfolio is now at $320,000. Those shares that he just sold, right? They're gone. They can't participate in the recovery. Then year two rolls out and the market drops another 15%. He's now down to $272,000. He withdraws another $30,000 and now he's at $242,000. But here's the painful part. Even when the good years come, and they do come, right? Because remember, the 20-year average return is identical for these two individuals. So David will be compounding from a base of 242,000 and not 500,000. So the same percentage gains that would have rebuilt Sarah's portfolio are doing far less work in dollar terms for David because his starting point got literally decimated in those first 2 years. Sarah, on the other hand, gets those same bad years in years 13 and 14. But by then, she's already had 12 years of solid positive returns compounding on her full $500,000 base. So when the drop hits, well, yes, it hurts, but she's absorbing it from a position of strength. And her portfolio is large enough that even a 30% drop doesn't fundamentally change her trajectory. So the average return over 20 years, again, is the same for both of them. But the order in which those returns arrived, combined with the fact that they're both withdrawing money every single year, means one of them ran out of money at 75 and the other still has $400,000 at 78. So think of it this way. If your portfolio drops 30% and you don't touch it, right? You need a 43% gain just to get back to where you started. That's hard enough. But if you also have to withdraw $30,000 while it's down, you need even more than that, right? Because you're working from a smaller base. So do that 2 or 3 years in a row right at the beginning, and the math becomes generally very hard to recover from. And this isn't something that I made up. Charles Schwab's research center actually modeled almost exactly this scenario. Two investors, same returns, but reversed in order, and they have the same withdrawals. And one runs out of money far sooner than the other. Vanguard documented it in real life too. A 1973 retiree with $500,000 who hit a bear market right at the start saw their portfolio completely depleted after 23 years. A 1974 retiree, same balance, same withdrawals, who simply avoided that one bad opening year, still had $300,000 left after 35 years. That's a 1-year difference in timing. And Wade Fall, who's a professor of retirement income at the American College of Financial Services, actually quantified it academically. The returns of just the first 10 years of drawing from a portfolio explain about 77% of the final outcome. So that's that first decade is basically what decides everything. So this is what's called the sequence of returns risk. And most financial content actually skips over this because it makes people uncomfortable. But I think it's probably the single most underappreciated financial risk for anyone who has real money in the market today and may need to rely on it in the future. So having said that, this risk exists regardless of how the market is doing. I mean, even in a perfect average market environment, the order of your returns matters enormously the moment you start withdrawing. But here's what makes it so much more relevant right now. If you skipped our previous videos, we're currently sitting at the second most expensive market valuation in about 140 years. The CAPE ratio is at extreme levels. The Buffett indicator, the most overextended it's ever been. And what those numbers have historically predicted is that going all the way back to 1881 is low or negative returns over the following decade. So it's more like a period where bad years are statistically more likely to happen. And that's exactly the environment where sequence of returns risk does its worst damage. So researchers actually call the 5 to 10 years before and after you start drawing from your portfolio the retirement risk zone. And we're heading into that zone at one of the most expensive market valuations in modern history. The bulls will say that earnings are strong, AI is driving real growth, the valuations are justified. And I did give that argument a full and fair hearing in the first 2 videos of this series. But even if they're right, that doesn't change what happens to David's portfolio the moment a bad year arrives while he's drawing it down. The math of withdrawing from a falling portfolio is very brutal, regardless of your views on AI or earnings growth. What actually protects you from ending up in David's situation? So the first thing is not writing drawdowns all the way down. And also having something in your portfolios that's generally uncorrelated to equities, that either holds steady or moves differently when stocks fall. And this is why the all-weather sleeve in my portfolio runs heavier right now than it would in a normal environment. It trades currencies and gold, and that's completely uncorrelated to the equity side. And when the valuation signals are as stretched as they currently are, well, it naturally gets more weight, specifically designed for the kind of environment where an early bad year could do the most damage. The second thing is the cash buffer. All right, about 50% of the capital inside our equity and crypto systems sits in cash at all times. And when markets drop, the system deploys into that discount rather than being forced to sell into it. David's fundamental problem is that he had to keep selling into declining prices to fund his withdrawals. And our systems are built so that forced selling doesn't apply here. And after talking to thousands of potential clients since 2021, I've noticed that most people build a portfolio for a market that literally just keeps going up. But David and Sarah has the same portfolio, the same returns. But the only thing that decided which one ran out of money was completely outside their control. But the good news is that it doesn't have to stay that way. Everything is linked below, and I'll see you in the next one.